Welcome to the Prosperity Health GP video series. As specialist advisors to the medical sector, we're acutely aware that our clients are time poor and that they're frequently not available during business hours. So what we've done is put together a series of short videos based on the common queries that we get to advise you on how to better manage your practice and better manage your wealth. My name's Gavin Fernando and I'm one of the wealth managers at Prosperity Health. Today I will be presenting on the topic of the superannuation reforms announced in last year's budget and enacted by legislation in November. Most of the changes are due to commence in July 2017. I'm going to focus on three elements. Firstly, the pension reforms. Secondly, one-off CGT relief that is available. And thirdly, amendments to the contribution caps. So what is all the kerfuffle about? Well, superannuation has been around for a long time. For more than 20 years, superannuation has been compulsory for Australian employees. These are the biggest changes that have come into play in the last 10 years. Superannuation is the preeminent retirement savings vehicle in Australia. As these are the biggest changes in the last 10 years, it's important that you're across what they mean for your superannuation savings. Firstly, the pension reforms. By way of background, there's two phases within the superannuation system. There's the accumulation or savings phase, and there's also the pension phase. So the first phase is when we're saving for our retirement. The second one is when we access superannuation in the form of a pension. The tax rate on the accumulation phase is 15%, and the tax rate on the pension phase inside the fund is 0%. There are two main changes that have come into place for the pensions. Firstly, there's what's known as a pension transfer balance cap that will apply to the amount of money that you can have in the superannuation pension phase at retirement. And secondly, there's an amendment to the tax exemption that applies to what's known as a transition to retirement pension. So just quickly to clarify, the difference between a transition to retirement pension and an account-based pension. A transition to retirement pension is available to a member who's met preservation age but hasn't otherwise met a condition of release. In those circumstances, they're able to start drawing on their superannuation as a transition to retirement pension. The pension balance transfer cap is $1.6 million. To the extent that the money that you have in pension phase exceeds that, you'll need to bring it back to $1.6 million by the 1st of July 2017. You can do that in one of two ways. You can either transfer the excess to the accumulation phase of super, or you can withdraw the money from superannuation. The system will be managed by the Australian Tax Office through your personal transfer balance account and managed through a series of debits and credits. Credits are applied to your account when you commence a pension, and debits will be applied to your account when you cease or commute a pension. Indexation on that $1.6 million is available, but it will only be indexed in $100,000 increments, and it will only apply if you haven't fully utilised your pension balance transfer cap. The main change with those transition to retirement pensions is that the exemption inside the fund will cease from the 1st of July 2017. From that point, the tax exemption no longer applies and any earnings backing that pension will be 15%. Of course, no cap applies to that type of pension. It's important to note that these reforms have no impact on the taxation of benefits that the member receives in their own hands. If you're over age 60 and you get a superannuation benefit, no matter how you're able to access it, it is non-assessable, non-exempt income and it won't go anywhere near your tax return. Next, I'm going to talk about a one-off limited capital gains tax relief provision. It was completely unexpected but most welcome. So in the previous area I noted that a pension transfer balance cap applies. So for some members they're going to have to take some action to move some money out of the pension phase and into the accumulation phase, or indeed withdraw it from superannuation. To the extent that taking that action triggers a capital gain, then a one-off limited relief is available. Now it's very important to understand it's not available across the board to any and all superannuation funds. It's available to those superannuation funds who, as a result of complying with the measures, would trigger a capital gain. The relief is one-off. It's available through what's known as the pre-commencement stage. Now that's a period that commences from the 9th of November 2016 through to immediately before the 1st of July 2017. Importantly, the trustee of the superannuation fund must make an election to apply for that relief, and having made that election, it is irrevocable. This is a trickier area than it might seem at first glance. The election is irrevocable. It applies to whatever assets the trustee chooses it to apply to. However, if a superannuation fund is in pension phase and another member in the fund might be in accumulation phase, the relief will apply across all the assets. And what that could do is it might actually trigger a capital gain in the accumulation phase that you'll never be able to unwind. It's a very tricky area and one that you need close advice on. Lastly, I want to speak to you about contribution caps. Since 2007, this has been the main way in which superannuation is regulated. There's two types of contributions you can make to a superannuation fund. Firstly, there's what's known as concessional contributions. Those are contributions for which a tax deduction is claimed, either by the member or by the member's employer. And secondly, there's non-concessional contributions, and these are contributions for which no tax deduction is claimed. The contribution caps for those who wish to make concessional contributions is currently $35,000 if you're 49 years of age or older on the 30th of June 2016, or if not, it's $30,000. Concessional contribution caps moving forward from the 1st of July 2017 will be $25,000 regardless of age. Non-concessional contribution caps are currently $180,000, or if you're under 65, there's the ability to bring forward the next 2 years' contribution caps and make a $540,000 contribution. From the 1st of July, that will change to $100,000 annually and a bring forward limit of $300,000 if you're under age 65. Apart from the reduction in the amount of money that you can get into superannuation, which is a very important component, there's one other important change that will occur on the 1st of July 2017. There's going to be brought into play a notion called your total superannuation balance. Your total superannuation balance will be assessed, and the closer it is or even exceeds that $1.6 million, there'll be a further constraint on the money that you can put in on an after-tax or non-concessional basis. This constraint could be down to zero. So you can see there's a one-off opportunity available to some superannuants that will not be available after the 1st of July 2017. In summary, the reforms may be seen as an attack on super, but superannuants should not consider that superannuation is any less useful in retirement savings. In fact, notwithstanding the superannuation reforms, superannuation remains the preeminent retirement savings vehicle. But these changes are the biggest that have occurred in 10 years. So it's important that to the extent you should make an election, that you make it. To the extent you shouldn't, you don't make an errant election. And to the extent that you're going to be constrained from putting more money into superannuation after the 1st of July 2017, you consider and avail yourself of the opportunity to do so beforehand. So the clock is ticking. Now more than ever, it's an important time to review your superannuation, and I encourage you to contact your Prosperity Health Advisor to do so. I hope you enjoyed this episode in the Prosperity GP Health series. For more information, contact your Prosperity Health Advisor or visit us at www.prosperityhealth.com.au. Thank you.